Hi, we are going to continue with the second recording on pro forma income statement, and this is where we stopped the previous recording. Total production cost for this period was for wheels 18,270 based on number of units to be produced times the new cost of units, and number for the second good, number of units to be produced times the new cost per unit. So total is 62,710. Now the next thing that we have to calculate is cost of goods sold, because this is the second element on the pro forma income statement. Pro forma income statement starts with projected sales, then we have to subtract cost of goods sold. So to be able to work on the cost of goods sold, we have to know which assumptions we have from accounting class. Remember, you can use FIFO accounting, first in, first out, or LIFO accounting method, last in, first out. But for the purpose of this application, we are going to use FIFO accounting method. So we are going to sell the old inventory first and then continue with the rest from the new production. This is what we are going to do here. So we are working on determining the gross profit from the pro forma income statement. So we start with sales. That's the first element, sales in dollars. To calculate sales in dollars, we have quantity times price. Quantity times price for each of the 2 units, that's total sales in dollars, money into my pocket. Then I'm going to work on the cost of goods sold, has 2 parts, old inventory and new inventory. On the old inventory, if you recall a few slides back, we had units existing in old inventory 85 times old cost of goods sold. That's the total cost of goods sold for old inventory first good. The same here, second good. Now, based on FIFO method of accounting, I am done with selling the old inventory, so now I have to sell the remaining production from the new production. So let's see, total, I want to sell 1,000 wheels. I already sold 85 old inventory, so 1,000 minus 85. Now I want to sell 915 of the new production. New production cost is different, you see it's higher. So that's going to be the product here. The same for the second good. I want to sell a total of 2,000 units. I already sold 180. So 2,000 minus 180. I'm going to sell the rest of 1,820 of the new production at $22 per unit, cost of the new production. So total cost of goods sold is going to be old inventory plus new inventory, 17,810. The same for the second good, old cost of goods sold plus new total. And that's going to be, these two numbers add up to 61,470. That's my cost of goods sold. To calculate gross profit, we have to subtract this cost of goods sold from sales, and that's my gross profit. Okay? And now the remaining part is how much is my ending inventory value? Ending inventory in dollar amount. And we can use this formula, beginning inventory from the previous slide, 4960 plus total production cost 62,710 minus cost of goods sold. Ending inventory is going to be 6,200. But I can actually, for the application part, we can use a more intuitive way to calculate the ending inventory in dollars. Let's see what we can use. Remember, a few slides back we said we are going to produce 1,015 units of the new production, and we sold, based on this cost of goods sold calculation, 915 units. So 1,015 units minus 915, we have leftover ending inventory, we have 100. 100 times 18, that's going to be 1,800. Keep in mind here. And then the same type of calculation for the second good. If you recall, we produced 2,020 units for the new production, and we sold, that's part of the cost of goods sold, 1820, which is going to be the difference, 2020 minus 1820, 200 times 22, that's going to be 4,400. 4,400 here ending inventory plus here it was, remember, 1,800, that's going to add up to 6,200. Another way, we are going to work with that formula on the application next. So up to this point, we followed all the elements pro forma income statement, the ones that we had to calculate, and then we have to fill in and subtract all the other expenses to finalize the income statement. Meaning we have to subtract the general and administrative expenses, interest expenses, and taxes, and payment to dividends to the shareholders. And this is what we have here. Sales revenue table for $100,000. Cost of goods sold, we calculated 61,470. Gross profit 38,530. Remember that big table 2 or 3 slides back. Everything that's coming after that is just given in this PowerPoint for the purpose of example. General and administrative expenses 12,000. Then we have interest expenses. Then we have taxes, 20% of this number come out to be 5,006. Earnings after taxes, 20,024. And we have common stock dividends. We pay, in this application, it looks like we don't have any preferred stock payments, but that's fine. And that's the net income. Here we have return earnings for common stockholders. So next we are going to go work on some applications on pro forma income statement.